Can you hear me? Yes. Thanks for having us, guys. We have so many mutual faces in this audience today that we actively insure. So we thank you for that. And as Taylor said, we really work with so many real estate investors, not just principal house insurance, where people have multiple properties. And what is a risk strategy to try and cut some of these costs, because they are ever changing and ever increasing right now, as we know, in every walk of life. We're seeing minimum rates increase this year 5%. I had a bunch of renewals last week, they were up 50%. And that's a head scratcher. Why is this? And you know, what are the factors that helped or caused this 50% increase? And there's so many factors that are logical answers that we'll explain today. And so we can have a bit of a better understanding of that. Taylor, is there on the next slide, is there those questions that we can just jump right into somehow? The tech man. Let's pipe down.
Side.
Yeah. Perfect. So first question of the day on the board right here. What's going on in the insurance market? We're seeing interest and inflation at all-time high right now, or in my generation at least. And we're seeing that effect for goods pricing and everything going up. And so with insurance, everything's on replacement cost. So if the goods and services are going up, the insurance premiums are going to be going up, follow suit with that. The biggest factor that we've seen is climate change. Are there anybody in this room doesn't think climate change is real? It is. There's so many causes. We're specifically talking about BC today. What did we just live through? Kelowna. I was just speaking to Kyle, it's going to be the next speaker. He had his wedding in Kelowna and it was getting very tumultuous in the summer. Like, can we hold this wedding? There's an active wildfire right beside us. This is unfortunately becoming the new normal. We're seeing wildfires at an unprecedented rate. We are seeing the floods that happened a couple years ago and almost took out Abbotsford and full cities, total burn downs of villages and towns. Those costs are bared by the insurers. And the reality is they're for-profit companies. And so what are they going to do if they're paying out $1 billion of insurable losses from the wildfire season? Me included in that, they're going to raise our rates. So how do you mitigate that? I think the short form is you unfortunately can't mitigate it directly. What you can deal with, though, is a broker such as ourselves or the brokers you currently have, because we have access to multiple insurance companies, and then they can re-rate, market that, move you. Is there a better rate? And there's still some people who will be targeting certain higher risk zones, and some people will be out. Some people will postal code check in the heart of the fire areas, and they will go, you know what, this is now a $6,000 home policy. And somebody else might say it's a $3,000 home policy. So you're going to need your broker here. This is a broker's market. You need somebody in your court. This is not the time to be setting up something online. That would be my huge takeaway for today. With the recent BC forest fires, talk about the different policies and protection for your home. We had hundreds of clients call into our brokerage during the heart of the fires, whether that was at the Shuswap or in Kelowna. Spence, do I have fire insurance? I'm freaking out. You know, we might get evacuated, really high tense situations. So we're there calming people down. And everybody in this room, and I've said it 1,000 times this summer, and I'll say it again today, you all have wildfire insurance in the policies that you've purchased. It's the first peril included in all policies. Condo, seasonal houses, detached houses, every policy, the first statutory condition of your policy is fire insurance, whether that's a candle fire or a wildfire. However, on that policy, on that policy, there's different layers of the fire insurance and the coverage that's included there. And what I mean by that is you want to check your policies for a condo perspective. Do you have the allocated right amount of contents? Or from a detached house perspective, is your house insured to the value that it should be? Have you been a client that you've just auto-renewed your policies every year? Trust my broker. The cost to rebuild a house has gone up so substantially that if you have not had a second opinion on what is the true cost to rebuild that house, the likelihood is, cool, you have fire insurance, but do you have enough? And I can guarantee you, if you took a hard look at a lot of your policies today, that you will find you will be substantially underinsured if you haven't had a good review with your broker recently. Last question for me, and then we're going to pass it on to Owen. So moving forward, will it be possible for people in these affected areas to obtain forest fire insurance? We firmly feel as a brokerage, it's always going to be attainable, but what is the price? What is the price here? You know, is this going to be the average home price is $5,000 a year? In some areas, that may be the case. The earthquake is the huge topic that Owen's going to cover secondly. Forest fire insurance is going to be very postal code specific and very fire protection specific. And what I mean by that is your house situated within 300 meters from a private hydrant? Sorry, private public registered hydrant. That's the biggest question. If you fall out of that zone, your house becomes what is called semi-protected. You're close to a fire hall, but you're not close to a hydrant. Therefore, you're in the second tier of the classification. So some people buy and come to me or our brokerage and they'll buy a nice, cute cabin in the woods. And that policy can and will cost them more than their principal house, which could be 3 times larger in Langley City proper because of the fire rating. So we do a lot of investigation for clients who call in and they ask, Spence, bought a seasonal house. Can you just take a quick look at this for me? Tell me it's not going to be $10,000 a year for this cabin insurance. And we'll do a quick audit of that and go, you know what, based on the fire protection, it won't be with certainty. So that would be a question. I think it's always going to be obtainable. Actually, I know it's always going to be obtainable, but what is obtainable to you? It's going to be a price, right? And going back to that point of being engaged with your broker, is this the best price? Because rates are up and they're here to stay. Until I think some of these insurance companies can replenish some of the claims they've just paid out. I'll pass it on to Owen.
Awesome. Thanks, Spence. And good morning or almost afternoon, everyone. So yeah, the next question. So earthquakes are a potential risk here in BC. What do we need to know about earthquake protection? So this is a really good question. Especially recently. So over about the past year, earthquake has been a huge topic for insurance in BC. If you're from BC, you probably know the talk of the big one is always looming. You know, it's always you know, thought about, and so insurance companies have now really taken a hardened stance on earthquake coverage. So what's becoming more normal is a lot of the companies are choosing to not write earthquake in certain areas. So depending on your postal code and where your property might be, we've had it where, you know, earthquake coverage was not attainable this year if we were binding new business. We've seen that in areas on the North Shore. I've seen it in some areas in Surrey and on Vancouver Island. If you can get earthquake insurance, the number of markets are becoming a lot less. The number of companies that are writing earthquake in certain areas are becoming less. So less companies that we can choose from to place business with. And across the board for everybody who has earthquake insurance, you're seeing your deductibles increase. So what used to be a standard, you know, minimum deductible of 5%, 10%, we're seeing 15, 20, or 25%. And when you're looking at these percentages on the rebuild cost of your home or of a building, you know, these can be adding up to hundreds of thousands of dollars of a deductible burden that you could incur if there was an earthquake claim. So much so that we're starting to sell a separate earthquake deductible product to insure your earthquake deductible, so that in the event of an earthquake, you don't have this, you know, hundreds of $1,000s burden and deductible that you have to pay. You have access to this policy where you pay a $5,000 deductible, and that policy is covering you up to whatever earthquake deductible that you could incur. Next question. So what does condo insurance look like if I live in the property, rent the property long-term, or rent the property short-term? So condo insurance in general, what we are insuring is your contents, any improvements and betterments that you have inherited from the previous owner or that you have made yourself. So we're not actually insuring any physical building structure. We're insuring you for your liability. So if you're living in the condo, that would be your personal worldwide liability. That would be applicable around the world if you're found liable for property damage or bodily injury. If you have the condo as a rental, that provides premises liability. So any sort of slip and fall or any sort of liable claims that could come upon you with regards to the premises. And then another big factor of insuring condos is your responsibility for any sort of condo deductible assessment. So say, for example, water damage originated from your unit and ended up damaging the building, you could be made responsible to pay that water deductible. And water damage is becoming so rampant among condo buildings and around Vancouver, BC, and elsewhere. When water damage trickles down through the walls and through the floors, it becomes very damaging. So what we're seeing now is insurance companies are increasing their deductibles. So we've seen strata building policies where you might own a unit within the strata building, but the building and the strata itself has an insurance policy to cover the entire building. We've seen deductibles as high as $750,000. So that means that if water damage originated from your unit and caused damage in excess of $750,000, that deductible is triggered, and the strata would make a claim under the building policy. You would then be made responsible for paying that $750,000 deductible because the water damage originated from your unit. And so what we're seeing is a lot of the condo markets that we place business with, they'll only cover up to $100,000. So we're having to source separate supplementary policies to cover that shortfall, $650,000. So that's kind of the state of where we are with condo insurance and water deductibles. Things are going up, as Spence said, and it's that's just kind of how things are going at the moment. So lastly, what is something that we want to leave with the audience today? So I think from my point of view, what we're seeing is, and Spence mentioned, but the rise in building costs. The cost to rebuild has been going up substantially year after year. And as he mentioned, a lot of you might be underinsured. And so what we would suggest is, if you have any sort of, investments in commercial buildings or even for your own personal home, get an appraisal or speak to your broker about getting an evaluator done again. Because on a lot of these, especially commercial building policies, there's something called co-insurance. And if you're underinsured, you're really actually going to pay a penalty in the event of a claim. If you insured a 50% of what the true value is to build that building today, you'd only get 50% of the claim paid out, even though you insured to 50%. So you wouldn't even get up to the limit that you insured to, you would get 50% of that. So just something to keep in mind. And Spence, I don't know, do you have one last point you wanted to make?
Yeah, I think a big takeaway for me is don't just put your insurance policy as exciting as insurance is, that's the running joke, right? Don't just put your policy in the cupboard creating dust for the year. Have at least at very minimum, have an annual review with your broker to review what do you actually have? What I'm spending $2,000, $3,000, $4,000, $5,000 a year. You should know, do you have this coverage? Am I covered for this? And what I say is, well, think before you do. I tell that to a lot of my clients. I have well over 1,000 clients. And I try and educate all of my new clients to say, don't just start a business in the basement and assume that's okay, or don't do an Airbnb in the basement and assume that's okay. Please call, because it impacts the insurance policy. And some of these impacts can be, hey, I had a water damage claim. And then the adjuster comes out and they go, well, you're running a nail salon in the basement, and they go, boom, claim declined and no coverage. So it's that strict. So think before you do. Look at your policy at least once a year, especially on the renewal. Speak to your broker, whether that's us, phenomenal, whether it's someone else, great as well. Just take a look at it would be my biggest point for today. So that's it, Taylor. Thank you. Yes.
So on that example that you just spoke of where the water damage, in the apartment, the deductible or your policy would only cover up to 100,000, so you're short 650,000. Is there some other, rider that you can buy to cover the difference? On
Yes.
your insurance, so like, yeah, you're gonna get 100,000, but if it goes above and beyond that to the 650 or 750, as you said, and you get a rider on it to do that.
Exactly, yeah. So you would have the main policy, which would cover you up to the first 100,000.
Right.
After that, none of the normal insurance markets provide coverage up above 100,000. But there are additional policies, supplemental policies, which you can purchase, like water deductible top-up policies,
Right.
which can cover that additional $650,000 shortfall. So you would have the main condo unit policy, and you would have a separate additional water deductible top-up policy, which is strictly providing you coverage of $650,000 in coverage for potential condo deductible assessment. But yeah, we can find coverage for that. Yeah.
So in regards to the value that you would pay for that to sleep at night, in case, because we hear about it all the time, something on bathtub running or blah, blah, blah.
Yeah.
Right? How would that relate roughly in cost? Like your policy, let's say is $2,000, is that gonna be another $2,000 or roughly?
Yeah, so I was selling them for about, and it was actually, when you looked at it incrementally, it didn't get as expensive the higher you got. So for a $650,000 top-up policy, that policy was like $2,200.
On top of.
On top of-
2K that you're paying.
Yeah,
So
exactly.
you're understanding that correctly.
Yeah. Yeah.
All right.
Yeah.
Thank you.
Thank you all. Thank you so much.
Thank you to both Owen and Spencer for all that valuable insight into the world of the insurance market. Our next and final speaker of the day today is Kyle Green. Kyle is the owner of both the Green Mortgage Team and Origin as well. And Kyle and his team help investors create generational wealth through real estate by helping them obtain mortgage financing and create a real estate game plan. Kyle has been in the top 25 mortgage brokers across the country since 2017 based on volume. So he's done a ton of mortgages over the last decade. He's a member of the REAG, the Real Estate Action Group. And so I know a lot of real estate investors here in the room have used Kyle in the past before. Kyle helped me get my first mortgage probably 7 years ago. And so he's definitely a great resource, lots of knowledge, and excited to hear today what's going on in the world of interest rates and how we can manage those. So thanks, Kyle.
All right. I know I'm the last person between you guys and bacon, so I'm going to try to be really quick here. Okay. All right. Well, let's start off with the first one here. The new rules with regards to short-term rentals. This is affecting a lot of people, and myself included as well, actually, in a pretty big way. Some of you may know that that we own a 7-unit building in Victoria that we use as a short-term rental. So a lot of my time yesterday was focusing on figuring out how this is going to affect us and how it will affect other investors as well. Just to give everyone some idea of what the government is trying to do here is they're trying to put more rental units back onto the marketplace. What they're insisting is that short-term rentals are eating up a lot of the available long-term rental units. And so they're trying to change that direction a little bit. So one of the things that we expect that we're going to see here based on their announcement is that there's a couple of timelines that are coming up, and without going into the minute details here, May and summer of 2024 is when a lot of these rules are going to be coming into play. But they're effectively going to be saying you need to be licensed, and they're going to be going to Airbnb, VRBO, et cetera, to ensure that if your listing is up on those websites, that you have to have the license from the city in order to be able to do that. So no longer is it a situation where sometimes with Airbnb, you used to be able to say, oh, I've got strata approval and therefore I can put it up on Airbnb. You'll now need to ensure that you have municipality approval. Now, there are some municipalities that will be exempt. There's a list of 14 of them that are listed on the website that is able to get sourced on this, as well as communities under 10,000 people. However, those communities will have an opportunity to decide to opt in or opt out of these policies. And so It'll be up to the cities to determine what they'd like to do and whether they'd like to participate with this or not. The general idea from the province is that, hey, if your vacancy rates are currently quite high, then maybe it's less important for you to be focusing on this. But if vacancies are quite low, which is true of most of the larger urban centers of BC, that we're likely to see that these rules are going to be coming down. Interestingly, there are also going to be some items here, and I'm very curious to see what comes out of this. But there's also zoning bylaws in different cities. So, as an example, I'll use Victoria again because I'm quite familiar with the Victoria situation. But there's a zoning called the Old Town District, which is where most of the short-term rentals exist right now. I'm very curious to see how Victoria specifically handles this, because Victoria has not come out and said this is what our stance is going to be on it. But I believe, or at least my assumption would be, that the province and these new guidelines will usurp the zoning. And so even though a lot of owners own properties in that Old Town District zoning because it was legal non-conforming to operate as such, we expect that the new provincial rules will perhaps override those. So very interesting to see. So what's going to happen then? Well, you're probably going to see a lot of units then be either sold or turned into long-term rentals. What you'll find is that in areas where there's a lot of short-term rental stock that will no longer be able to continue, you'll probably see an increase in supply of those units available in the marketplace. And so I think that values over the next 6 to 12 months may start to decrease in those areas where there's a lot of short-term rentals. And we'll probably also see a short-term blip and decrease perhaps, or at least no further increases to long-term rental rates. If there's a large number of rental properties now hitting the long-term rental market, then you'd expect that you wouldn't see as much appreciation on the monthly rental income attainable in those units. So be interesting to see what happens here. Lots to digest, and I could probably talk the entire time about this one thing, which I won't do. I'm looking at probably putting together a bit more of a formal review and analysis on this myself to understand it in as much detail as possible. But there's lots to look into, but I do think it'll affect the market in many ways. All right. I would be a good mortgage broker if I didn't talk about where interest rates are heading. I will say this, the last 20 months, it's been really, really, really hard to predict where interest rates have been heading. And guess what? A lot of people have been getting it wrong. All the economists have been getting it wrong up until this date. And so I can say what I expect and what the economists are telling us today, but guess what? These are the same people that 6, 12, 20 months ago were saying completely different things. To give you some context and perspective, a lot of the economists were predicting that the prime rate would have probably hit about 4.7%. We are currently at 7.2% prime rate. And this is based off of information after the rates started to rise and as of May of 2022. So not that long ago. And that was after, from January, that's when the rates started to increase. And so it was already into the increase, and that's what a lot of the chief economists with the banks were predicting would happen to interest rates, and they far exceeded that, as we all know. So the question of where are they heading? If I assume that economists know what they're doing, which is a very far leap and a big assumption, the current expectation is that the prime rate is likely to stay flat or perhaps go up one more time at some point between now and Q1 of next year. It seems like as of today, there's less than a 50% chance the Bank of Canada goes up next week when they make their announcement. And so it doesn't seem that that's likely to be the case, but there's still about a 50% chance or slightly less that between now and sometime in Q1 that there may be one more prime rate increase, just to make sure that we really crush everybody's soul, right? So especially real estate investors. Now the whole higher for longer thing, keep in mind too, governments are trying to control inflation, and that's what they're doing by increasing interest rates. Do you think that they want to tell you, hey, we're increasing your interest rates, but guess what? We're going to decrease them really, really soon. Do you think that they're going to want to signal that? Probably not. And so I think verbally they're telling people, hey, we're going up and we're going to stay there for a longer period of time to make sure that people continue to pull back on spending. They want to make sure that they can curb inflation. And so this is something that's really important. It's one thing to do and take certain actions. It's another thing to also make sure that the communication with the public is perceived in the way that they want it to be perceived. That being said, it does seem like interest rates are not going to be getting back to those 2% or 3% interest rates anytime soon. So don't expect that. The general expectation is the Bank of Canada will slowly start to decrease the interest rate, the prime rate down to about 5.2%, probably over the next 2 years, approximately. And the timeline for this is that probably sometime in the middle of next year. So we're hearing different economists predict anywhere from about July to October of 2024 is when the prime rate will start to decrease. On average, most of the economists are predicting that the prime rate will be about 0.5 to 0.75% lower by the end of 2024 than it is today, and then another 1 to 1.5% lower by the end of 2025. So that's the general expectation. On the fixed rate side, we follow the bond yield chart. And normally when I do a presentation, I usually like to have a bond chart, which is the most interesting thing ever. Again, trying to keep you guys from the bacon, make sure that I put some cool charts up. Bonds on that side of things, the expectation is the bonds will be down about 0.75% from where they are today compared to the end of next year, which means fixed rates should be about 0.75 lower by the end of next year, and then another about 0.5% lower by the end of the following year. One very quick thing I want to mention, however, we're seeing some very interesting things in the bond market right now, because municipalities, and especially down in the US, they're getting to a point where they're borrowing from Peter to pay Paul. What I mean by that is that their cost of servicing their debt is becoming so high because they've issued so much debt, and the cost of that debt is starting to rise. And in order to be able to service their payments on debt, they need to raise more debt. Does that sound like a good thing or a bad thing? Probably a bad thing. And so what happens is you can have this, this acceleration in interest rates, because all of a sudden you start to price that debt at higher risk. And if it's a higher risk, then what do you want? You want a higher yield, right? You want a higher interest rate. And so we're actually seeing that very recently, there's been a bit of a spike in the bond market, and it's not because of expectations on inflation. It's based off of the perceived risk of buying government debt, particularly in the US, but unfortunately our debt market closely follows the US. And so we are in a weird spot where we could see some further acceleration in the bond market, which would mean the fixed rates could be even higher than they are today. So am I recommending a fixed rate or a variable rate right now? I will say for the last almost 2 years, for the most part, short-term fixed rates have been the recommendation. The most commonly chosen term has been the 3-year fixed. We are in an interesting time where the short-term fixed rates, like a 1-year fixed, are quite high, like over 7 with most banks. 2 years are close to 7%. 3 years are about 6.5%, and then 4, and then 5 years. Getting 5 years getting closer to about 6%. In some cases, you can get a little under 6 with 5-year fixed, but for the most part, they're still a little bit over 6. So we're in an interesting time. We're trying to figure out what the right term selection is. And for the most part, the 3-year fix has been the most common or most popular. I will say, however, that some of our clients are starting to think of variable if you can get a deep discount variable. So as of right now, there's a couple of different lenders that are offering a rather large discount of prime minus 0.9% roughly, which would be 7.2% minus 0.9 is 6.3. So if a 3-year fix is 6.5 and a variable is 6.3, are you getting into a variable that has more room to go down than we expect to go up? Now, of course, that's only for the individuals that can afford that and are, it's not for the faint of heart, let's put it that way. So most of the clients that are opting for the variable today have deep pockets. It's not a matter of, hey, if the rates go up, I'm going to get crushed. It's more of, hey, I do think that the variable rate will outperform fixed. And if it doesn't, I can afford it, is effectively the situation. I did create a spreadsheet because I love spreadsheets. Those of you that know me really well know that I love spreadsheets. I create a spreadsheet that allows you to compare a short term versus a longer term. So we can look at what the break-even rate would be after the expiration of the shorter term for you to be better off taking a shorter term versus a longer term. And also we keep a spreadsheet that we update about every month or so with the current variable rate expectations. And so you can also look at mapping out, what if I take a 3-year fixed versus what if I take a variable rate, and what would happen? And you can modify and manually change the expectations on the prime rate too, just to stress test it a little bit. So we found that that's a really helpful tool, especially if you're coming up for renewal and you're not really sure if you should go variable or fixed or taking a new mortgage today. It does help with that decision-making process and take the emotion out a little bit. So with rates increasing along with the stress tests rising, how are some of the ways we're getting deals done? I will say this, it is way harder to get a deal done today than it was a couple of years ago. To put things in perspective, when you have a 6.5% interest rate We have to qualify you as if your rate is 8.5%, just crazy. So what we've seen actually is borrowing power has eroded by over 25%. So back in COVID days, you could qualify for about 5 times your income was the expected amount you'd qualify for. Now it's about 4 times your income. And so it's considerably pulled back. And unfortunately, the real estate values have not dropped enough to offset this factor. And so we've noticed and felt that a lot of our deals have to get done through either net worth programs, where if you have a large liquid net worth of over $250,000, then you may be able to qualify under a net worth program. Basically, they say if your income qualifies you for a $500,000 mortgage, and let's say that you have $300,000 in liquid assets, you may qualify for the 500 plus the 300,000. So you can qualify for an $800,000 mortgage. The thought there is that you could liquidate those assets and pay down the mortgage to an amount where your income could carry it. There's also what we call corporate net income programs too. So if you're self-employed and you have incorporated income, there are ways that you can qualify for a larger mortgage based off of that type of program too. So there are ways that you can still get deals done, but it is a lot harder than it was just even 2 years ago. Okay, so are my investor clients still buying and what are they doing? Not really, not really. A lot of our investor clients have kind of tapped the brakes, and for good reason. Why invest into a real estate market that may actually be short-term anyways, decreasing, when you can get a GIC for 5%? Sounds great, right? So the question is, what are investors doing? Well, I'm definitely noticing a lot less investors are borrowing money to invest. Now, that doesn't make sense if the cost of borrowing is much higher than it had been in the past. And so we see a lot less of that. We see a lot less of investors buying properties. What we have seen leading up to this point is a lot of investors either converted long-term rentals into short-term rentals to try to match and get higher income off of those properties, or have been purchasing properties as short-term rentals. So there's some concern about those that made a judgment or based a call on saying, hey, if I do a short-term rental property here, then the numbers will actually work, but if I do long-term, it doesn't. So that should be interesting to see. But what I am finding investors are doing right now is 2 things. When the cost of borrowing money goes up, well, instead of owning the real estate, what a lot of our investors are doing is they're lending on the real estate. So typically, if you're a private lender, then you can lend on real estate assets, and usually you get about prime plus 3 to prime plus 4 on your debt. So if you could, and this is even where some clients are borrowing against their line of credit to lend out, because their cost of borrowing is well aligned to the income that they earn by lending it out. And so we are seeing that because there's a higher supply and demand for private lending, because the market has tightened on the lending side, we're finding that there's a lot more money and people that need the money in the private lending side. So a lot of people are borrowing money on that. So a lot of investors are doing that. The second thing, all of the speakers today have talked about the challenge with the amount of supply in Vancouver. And one of the ways that the federal government is trying to fix this anyways, is to try to affect the demand side. It's really hard for them to affect the supply side, but they can try to change the demand and increase the supply in some ways. And the way that they're doing that is through CMHC insured multifamily financing. And so CMHC, without getting into a lot of details, if you tick a few of the boxes, you can get up to a 50-year amortization, up to 95 or even 100% financing. And the interest rates are lower than the best residential interest rates, like somewhere in the low 5s. And so this is, I think, where a lot of money is going to go. And I think that investing, and you're going to find a lot of the mom and pop investors that typically would have bought 1 or 2 or 5 residential properties. I think you're going to see a lot more people say, well, let's get into multifamily, but then I don't have enough capital to get into multifamily. So I think you're going to see a lot more people grouping money together, either 4 people getting a joint venture going together, or investing a lot of the funds that Integrated Equities has been talking about today. So I think you're going to see a trend away from investors owning residential real estate and into owning a piece of a larger property and taking advantage of the scale and being able to get into the CMHC insured multifamily financing. A couple of common mistakes that we're seeing clients make today. Not a lot of mistakes, I would say, because not a lot of our clients are doing a whole lot, especially on the investor side of things. One of the biggest mistakes, of course, is just over leveraging themselves. And so when we see clients that have a vehicle loan and a bunch of other debt, These are always concerns of ours. Making sure that you roll up all of your debt underneath the mortgage typically is the best way to go, just because the interest cost and the monthly payments are lower when you do that. The second biggest mistake that I'm finding right now is on the pre-sale side of things. If you have a pre-sale coming up in the next 18-24 months, you should be ensuring that you have a long-term rate hold and a long-term approval for that. We're finding that even though we don't think that interest rates will rise much further than they have already, they still could. And it's really concerning when we have people that are coming to us now and saying, oh, I've got a pre-sale completing in 3 months. And we look at it and say, man, if only you had come to us 12 or 18 months ago, we could have gotten you an approval and you would have been good. And in fact, a lot of these lenders will issue an approval. And even if you lose your job, they'll still fund your mortgage, which is crazy. So if you're in a situation where you do have pre-sales coming up, it's really important that you talk to somebody, either a broker or your bank, to make sure that you get a long-term rate hold done. And the other thing that I'm noticing too in the conversation of rate holds is that clients that are using their bank, you can only have one rate hold in effect with the bank at any time. One thing that we found is that it's been difficult for clients to find new properties to purchase. And as a broker, we can layer your rate holds and layer the pre-approvals. So today the rates go up, we send you off to one lender. And then in a month from now, right, the rates go up again and we send you off to a new lender. And then rates go up a month from there, we send you in. So we're actually layering the rate holds, which means that by the time you buy something, we can look back 4 months and find the best rate in that 4-month window. When you have one rate hold with one bank, you get the rate hold, and then eventually in 4 months it expires, and now you have the huge jump up to whatever the current rates are at that time, instead of having this layered approach, which is something that we found normally isn't as valid or important, but it has been lately. So 3 things I want everybody to leave today with. Number 1 is definitely, if you have a mortgage coming up for renewal, you need to shop it around. I'm finding that right now more than ever, there's a bigger gap between certain lenders. So there's a lot of new policies and a lot of new requirements for some banks. For example, Scotiabank for a very long period of time has been relatively uncompetitive in the marketplace as far as their interest rates are concerned. And so clients that are coming in for renewal with Scotiabank, we're finding that we're actually moving them out and getting them much better rates elsewhere. So it's more important now than ever to make sure that you shop that renewal, especially with rates going up as much as they have. Second thing that I want to point out too, I think that the next 6 months might be one of the best buying opportunities for investors. I expect that you're going to see a lot of these people that bought short-term rentals, and now all of a sudden these new policies are coming out. We're starting to see the market turn. The amount of supply in most major urban centers in September reached a short-term high. And so I think a lot more properties are entering the market, and some of those sellers will be motivated sellers. So if you're an investor that's been sitting on the sidelines, now might be this opportunity in the next 6, maybe 9 months or so to maybe find a motivated seller and finally get the deal that you're looking for to help offset the fact that the interest rates are much higher as of today. And then the last thing I want to leave everybody with is something that I've been working on for quite some time, but it's actually some software that allows us to automatically look at your portfolio and let you know, without any documents and without a credit bureau pull, we can tell you where you qualify, what kind of interest rates we'd be able to get you, and we can actually tailor make and look at portfolio game planning without having to collect all the documents, because who likes documents? Yeah, with one person likes documents. Okay, interesting. I've got a job for you, by the way. Most people don't like documents, and neither do we. So the software allows us to underwrite and look at your different options without having to collect all those documents and dive in head first. So make sure that you reach out if you do want to get a portfolio review. Reach out to us and let us know.